Welcome to the Deep Dive, where we aim to get you well-informed and fast.
Hope you're ready.
Always. Today, we're tackling something pretty universal because, well, life throws curveballs, especially financially.
Yeah, uncertainty is kind of the name of the game, isn't it? And most of us want some way to shield ourselves, our families, from the fallout.
Exactly. So we're building that financial safety net idea. And today's Deep Dive is all about a key part of that, life assurance.
That's the plan.
Right. Our mission today, unpack life assurance, what it is, the different kinds, how it actually works in practice. We want you to walk away feeling pretty clued up on this, without your head spinning.
It can seem dense, definitely.
It can. But think about maybe having a mortgage, wanting your family looked after financially, even inheritance tax planning. Life assurance pops up in all these areas.
It really does.
So we've sifted through some solid sources, pulled out the key stuff to guide you through it.
Okay, so let's dive in. The absolute core idea. What is life assurance?
Good starting point.
At its heart, it's a product, right? It gives financial protection when someone passes away. Basically, it's a promise that money gets paid out to beneficiaries. Vital support when it's often needed most.
Okay, but there's this term thing, assurance versus insurance. People mix them up. I know I do sometimes. Does the difference actually matter? Our sources flagged this.
Yeah, it's a bit more than just words. Strictly speaking, insurance covers something that might happen, like a car crash or a fire. It's uncertain.
Right, you hope it doesn't happen.
Exactly. Assurance, though, covers something that will happen eventually, death. The event is certain, we just don't know when.
Okay. Certainty versus possibility.
Precisely. But here's the catch. Even though we call it life assurance, a lot of policies, especially term ones, are technically more like insurance. Why? Because they only pay out if death happens within a set time.
So it depends on whether the payout is guaranteed whenever death occurs, or only if it's within the policy's window.
Got it. That helps frame it. Definitely. And to really get to grips with this, there are a few key terms we need. Our sources lay these out.
Okay, let's have them.
First, sum assured. That's
Yeah.
just the amount of money paid out. Simple enough.
The payout amount. Yeah.
Then, life assured. That's the person whose life the policy covers.
Okay.
Policyholder, the person or entity that owns the policy, pays the premiums. Often the same as the life assured, but, not always.
Right. Could be a business taking it out on an employee, for example.
Exactly. And finally, the term. That's the length of time the cover lasts for.
Term, sum assured, life assured, policyholder. Okay, foundational stuff.
Got this. Good, because now we can dig into probably the most common and often the most accessible type.
Right.
Term assurance.
Right. This sounds like the starting point for many people. Pure protection.
That's it, exactly. Term assurance is just that protection for a fixed period. No investment frills, no savings element, pure safety net.
And because it's simple, it tends to be cheaper.
Generally, yes. Often the most cost-effective way to get a decent amount of cover relatively quickly.
Makes sense. And you mentioned its uses personal, family, but also business.
Oh, absolutely. Its versatility is huge. Personal protection is obvious, making sure the mortgage gets paid, kids are supported. But in business, think key person insurance.
Right, covering the loss of someone vital to the company.
Yeah, it can literally give a business breathing room to recover if a key founder or salesperson dies unexpectedly, stops things collapsing overnight, or partnership assurance helps remaining partners buy out a deceased partner's share. Keeps the business stable.
So, incredibly practical. Okay, let's break down the features. How does it actually work day to day?
Key thing. The money, the sum assured, only pays out if the life assured dies within that specific term.
And the term itself, how long can that be?
Pretty flexible, actually. Could be just a few months, maybe for a short project loan, or it could stretch out 40 years, even more sometimes, for long-term family needs.
Okay, and what if you outlive the term?
Then the cover just stops. And importantly, you don't get any premiums back.
Okay, so you were paying purely for the risk coverage during that time.
Exactly. It's like renting protection. Rent's over, protection's over. There's also no cash in value, no surrender value you can get back.
Right, and premiums.
Usually paid monthly or annually. Sometimes, though rarely, a single premium for the whole term, and generally the premiums are level.
Meaning they stay the same amount each year.
Correct. You pay the same monthly or annual amount throughout the term. Even if, and this is interesting, the actual sum assured changes over time.
Okay, the sum assured can change. That leads us into the different flavors of term assurance, doesn't it? They're not all the same.
Not at all. Each is tailored for specific needs. First up, the simplest, level term assurance.
Level means.
The sum assured stays the same, flat, constant throughout the whole term, predictable payout.
Okay, so you'd use that for, say, an interest-only mortgage where the debt amount doesn't decrease, or just providing a fixed lump sum for the family.
Exactly. Covering a debt that isn't reducing or providing a consistent level of family support for a set number of years, maybe while kids are dependent, static liability, static cover.
Got it. Then what's the opposite?
That would be decreasing term assurance. Here, the sum assured actually goes down over the policy term.
Why would you want less cover over time?
Think about a repayment mortgage. The amount you owe decreases each year.
Right, as you pay it off.
So this policy is designed to match that decreasing debt. The sum assured reduces, often mirroring the mortgage balance. Our sources mention it decreases slower at the start, faster towards the end, mirroring how mortgage repayments work.
Ah, clever. So the cover always roughly equals the outstanding loan. You're not overinsured.
Precisely. Very common for repayment mortgages. Keeps costs down, too, as the risk reduces.
Okay. Now, our sources mention something quite specific sounding. Gift inter vivos policies. Sounds complex.
It's niche, but really useful for inheritance tax planning. Gifts inter vivos just means gifts made during your lifetime. Often these are potentially exempt transfers or PTs.
Potential tax bombs, basically.
Sort of. If you make a big gift, say, to your children, and then you die within 7 years of making it, that gift might get pulled back into your estate for inheritance tax calculations.
Ouch. So this policy covers that tax risk.
Exactly. It bridges that 7-year gap. You set the sum assured based on the potential tax due if you died straight away. That sum stays level for the first 3 years after the gift.
Okay.
Then, from year 3 to year 7, the potential tax bill reduces because of something called tapering relief. The policy reflects this. The sum assured also starts to decrease, matching the reducing tax liability.
And after 7 years.
The gift becomes fully exempt from IHT, so the policy cover is no longer needed, and it just ends. It's a very smart, targeted tool for estate planning.
Very clever. Okay, what about adding flexibility? I think convertible term assurance does that.
It does. This one has a really valuable feature built in. The option to convert the term policy into a whole-of-life policy, or maybe an endowment policy later on.
And convert it, so change it from temporary cover to permanent.
Yes, and crucially, usually without needing any more medical questions or checkups.
Ah, that's the key. So if your health gets worse after you take out the first policy.
You can still lock in permanent cover later at standard rates for your age at conversion without being penalized for your health change.
That sounds like a valuable option. Does it cost more?
Typically, yeah. It may be around 10% extra on the premium for that conversion option, but the flexibility can be worth it. And the new policy can even run for longer than the original term.
Interesting. Okay, other variations, things that grow or renew.
Yep. Increasing term assurance. Does what it says on the sum assured goes up each year, usually by a fixed percentage or amount.
Why? Inflation.
Primarily, yes. To make sure the payout keeps its purchasing power over, say, 20 or 30 years. £100,000 today isn't the same as £100,000 in 20 years.
Good point. And renewable.
Renewable term assurance gives you the option to renew the policy at the end of the term, again, usually without more medical evidence.
So you can extend the cover.
Yes, for another term of the same length, though there's usually an age limit, maybe 65, for when you can renew. And the premium for the new term will be based on your age at renewal, so it will go up.
Right, makes sense. Now, one more term type mentioned was quite different in how it pays out. Family income benefit. FI.
Ah, yes. FIB is different. Instead of paying one big lump sum when the life assured dies,
It pays out.
a regular income, like
Yeah.
a salary replacement, maybe monthly or quarterly payments. These payments start on death and continue until the original end date of the policy term.
So it replaces lost income stream directly. That sounds incredibly useful for families.
It can be fantastic. It provides ongoing support. And there's flexibility too. Payments can be set up to increase each year to fight inflation. Or sometimes the beneficiaries can choose to take a discounted lump sum instead of the income stream if that suits them better.
Can you give an example?
Sure. Source mentions Stephanie taking out an FIB policy. It pays £2,000 a month. If she died with 16 years left on the policy term, her family would get £2,000 every month for those 16 years.
Wow, okay. That adds up. £2,000 times 12 months times 16 years.
Yep, that's £384,000 in total, but paid out steadily over time. A real ongoing safety net.
So term assurance seems really versatile, covering specific periods or needs in different ways. But what if you want cover that, well, never runs out?
Ah, now you're talking about whole of life assurance.
The name kind of gives it away.
It does. This type of policy is designed to cover the life assured for their entire life. As long as you keep paying the premiums, it will pay out eventually whenever death occurs. It's permanent protection.
Okay, so why would someone choose this over term? What's it typically used for?
Several key reasons. Protecting dependents long term, maybe if you have a child with lifelong needs. Providing a tax-free legacy or inheritance for heirs. Covering final expenses. Funerals aren't cheap. And a big one, funding inheritance tax.
Right, because the tax bill often comes due whenever you pass away, so you need cover that's guaranteed to be there.
Exactly. Now, premiums. How do they work? Do you pay forever?
Good question.
You can. Premiums can be payable throughout your whole life. Or you can opt for a limited payment term, say pay premiums for 20 years only. Or pay until you reach age 60 or 65, but the cover still lasts for your whole life after that.
Okay, so options there. What about getting money out before death? Do these build up cash value like some other products?
They can build up what's called a surrender value, especially later on. But, and this is important, our sources stress these values are usually quite small compared to the premiums paid, especially in the early years.
So don't think of it as a savings account you can dip into easily.
It's definitely not. Its main job is protection, providing that guaranteed payout on death.
Right.
The potential surrender value is secondary.
Understood. Now, you mentioned inheritance tax. There's a specific type of whole of life for couples, right? Joint life, second death.
Yes, exactly. This is a really strategic tool for married couples or civil partners dealing with IHT.
How does the second death part work?
It means the policy pays out only when the second partner dies. This usually aligns with when the main IHT liability falls due on the combined estate, because assets often pass tax-free between spouses on the first death.
Ah, okay. So it pays out just when the tax man is likely to knock on the door for the estate taxes.
Precisely. And crucially, these policies are almost always written in trust.
What does writing it in trust achieve?
It means the policy payout goes directly to the trustees, outside of the deceased's estate. The trustees can then use that money to pay the IHT bill immediately. This stops the payout itself becoming part of the estate and potentially being taxed again.
Very smart. Keeps the money ring-fenced for its purpose.
It's a cornerstone of effective IHT planning for many couples.
Now, just like term, these whole-of-life policies aren't all identical. They have different underlying structures, especially around investment.
Correct. The way the policy potentially grows or doesn't varies a lot. The simplest is nonprofit whole of life.
Nonprofit sounds basic.
It is. Fixed sum assured, fixed premium, no link to investment performance, predictable, but no potential upside for market growth. You know exactly what you'll get.
Okay. What's the next step up?
With profits. This is where things get more interesting. You still have a guaranteed minimum level of cover, but the insurance company adds bonuses based on its investment profits.
Bonuses, like a work bonus.
Kind of. There are usually two types. Reversionary bonuses are typically added each year, and once added, they're usually guaranteed. They increase the basic sum assured permanently. Think of it like locking in gains.
Okay, steady growth.
And then there's often a terminal bonus, which is a potentially larger one-off bonus added when the policy pays out on death. It reflects the overall performance over the policy's lifetime, but it's not usually guaranteed until payout.
So you share in the company's investment success.
Essentially, yes. The company shares its profits with these policyholders. And it's quite regulated now. The FCA, the regulator, makes companies publish detailed documents, principles and practices of financial management, or PPFMs, explaining exactly how they manage these funds and decide on bonuses. Transparency is key.
Good to know. Okay, what if you want more direct market linkage?
Then you're looking at unit-linked whole of life. Here, your premiums buy units in an investment fund. A bit like buying shares.
So the value depends entirely on how those units perform.
Pretty much. The value of your policy and potentially the death benefit above a guaranteed minimum goes up or down with the unit price. More potential upside, but also more direct exposure to market risk.
Right, you're taking on the investment risk.
You are. And then there's a hybrid, unitized with profits.
Merging the two.
Kind of. Premiums buy units, but then the company adds with profits bonuses, often reversionary bonuses, to the unit value. Sometimes these come with guarantees that the unit price won't fall below a certain level, offering a bit of a safety net against market dips.
Trying to get the best of both worlds, maybe.
That's often the aim. Now, another combination policy is low-cost whole of life, sometimes called a minimum cost policy.
Low cost sounds appealing. How does it work?
It's actually a mix of a with profits whole of life policy and a decreasing term assurance policy bundled together. It was historically designed to be a cheaper way to potentially cover an interest-only mortgage.
How does combining them make it low cost?
The idea is you have a smaller core whole of life element that aims to grow with bonuses, plus a larger decreasing term element that provides the rest of the cover initially. As the whole of life part hopefully grows over time, the decreasing term part reduces, but the total death benefit aims to stay at the target level, like the mortgage amount.
Ah, so relying on bonus growth to make up the difference as the term part shrinks.
Exactly. The hope is the bonuses on the with profits part will be enough. It was seen as a lower premium than a full with profits policy, but with more risk if bonuses didn't perform.
Right, less guarantee. Okay, what about maximum flexibility?
That's where flexible whole of life comes in. These are usually unit linked at their core.
Flexible how?
The policyholder gets a lot of control. You can often vary the level of life cover, change premium amounts, take premium holidays, or even cash in some units if needed, although that usually reduces the cover. It allows the policy to adapt as your circumstances change.
And you mentioned different cover levels, maximum, minimum.
Yeah, companies often structure it like this. Maximum cover uses some of the invested units each year to pay for the highest possible level of initial life cover. Minimum cover just maintains the lowest level of cover needed for the policy to keep its tax advantages. And balanced cover tries to strike a middle ground, aiming for a steady level of cover throughout life by managing the units and premiums.
Lots of options there. And then there's universal life. Is that even more flexible?
Think of universal whole of life as the super flexible enhanced version. It's typically an extended flexible unit-linked policy, but the key thing is the wide range of additional benefits you can bolt on.
Optional extras. Like what?
A whole menu, often. Things like critical illness cover, paying out on diagnosis of a serious illness, income protection, replacing salary if you can't work, accidental death benefit, paying extra if death is accidental, total and permanent disability cover, even hospital benefits, paying a daily amount if you're hospitalized.
Wow, really building a comprehensive package.
Exactly. Plus, options like guaranteed insurability, letting you increase cover later without more medicals, maybe when you get married or have kids. Indexation to inflation-proof the benefits. And a really important one, waiver of premium.
We touched on that. Remind me what waiver of premium does.
It's a vital safety net. If the policyholder becomes seriously ill or disabled and can't work, this benefit means the insurance company essentially pays the premiums for them.
So the cover stays in place even if you can't afford the premiums due to illness.
Precisely. It stops a health crisis forcing you to lose your life cover just when your family might need it most. Hugely valuable add-on for many people.
Okay, that covers a lot on whole of life. Let's move to our final big category, endowment policies. These feel a bit more historical now, but they were massive, weren't they?
Oh, hugely popular, especially back in the 80s and 90s. Often sold as savings plans and very commonly linked to interest-only mortgages.
So what's the core concept? How do they differ from whole of life?
They have similar investment structures, nonprofit, with profits, unit-linked, etc. But the key difference is that an endowment runs for a fixed term, say 10, 15, 25 years. And it pays out the sum assured either if the life assured dies during the term or if they survive to the end of the term, the maturity date.
So it pays out on survival too. That's the savings element.
Exactly. It's designed to produce a lump sum at a set future date or pay out earlier on death.
Okay, let's quickly run through the types, mirroring of the whole of life structures. Nonprofit endowment.
Fixed sum assured, payable on maturity or earlier death. Fixed premiums. Return isn't linked to the stock market, so you're shielded from risk, but no share in profits either. Rarely used now because returns tend to be low.
Right. Full with profits endowment.
This was the classic mortgage endowment. Fixed basic sum assured, plus reversionary and terminal bonuses added from the company's profits. The hope was the final payout, basic sum plus bonuses, would be enough to clear the mortgage at the end of the term.
The hope being the key word there sometimes.
Indeed. Then you had unit-linked endowments. Premiums by units, value depends on unit performance. The policyholder carries the investment risk. If the units don't grow enough, the mortgage might not be repaid.
More direct risk and reward.
And unitized with profits endowments, again, combining the unit structure with the smoothing effect of with profits bonuses.
Now, you hinted at it. The hope didn't always pan out. Our sources mention endowment mis-selling. This was a big scandal, wasn't it?
It really was a huge issue for the financial services industry. Basically, in the boom years, these policies were sometimes sold very aggressively.
Now, so what went wrong?
Risks weren't always properly explained. Potential returns based on high bonus rates were sometimes overstated, giving unrealistic expectations. And sometimes they were sold to people who really couldn't afford the investment risk, people who needed certainty.
So when stock markets didn't perform as well, or bonus rates were cut,
The final payouts weren't enough to cover the mortgages they were meant to repay. This led to widespread complaints, regulatory action, and significant compensation payouts.
a tough lesson. And ultimately, if the policy didn't grow enough,
The shortfall was the borrower's problem. They still had to find the money to pay off the rest of the mortgage. It really highlights the importance of understanding the risks you're taking with any investment-linked product.
absolutely. Caveat emptor buyer beware. One last point on endowments and other life policies they can be assigned.
Yes, that just means the ownership and rights under the policy can be legally transferred to someone else, a third party.
Why would you do that?
Lenders often required it for interest-only mortgages. You'd assign the endowment policy to the bank or building society. It acted as security for the loan. If you died, the payout went straight to them to clear the debt.
Okay, so it gives the lender security.
That's the idea.
Right. Well, that brings us towards the end of this deep dive into life assurance. We've covered a lot of ground.
We certainly have, from the basic definition, that assurance versus insurance nuance.
Through the key terms, sum assured, life assured, policyholder, term.
Yeah.
Then we hit term assurance, pure protection for a set time.
Exploring all those variations, level, decreasing, the clever gift inter vivos for IHT, convertible for flexibility, increasing against inflation, renewable, and that income-paying family income benefit.
Then we switched to whole of life for permanent cover, looking at nonprofit with profits with its bonuses, unit-linked, unitized with profits, low-cost combinations, flexible, and the all-encompassing universal life with its add-ons like waiver of premium.
And finally, endowment policies that blend of protection and savings for a fixed term, their different types, and that important historical context of the mis-selling issues.
It's a complex landscape, but hopefully breaking it down like this gives you a much clearer picture. You should now have a pretty solid grasp of these tools.
Yeah, the foundations are definitely there now.
So the final thought to leave you with, now that you understand the mechanics, the differences between pure protection like term, lifelong cover like whole of life, and the savings blend of endowments. It really prompts a question, doesn't it?
Which is?
What financial risks, what uncertainties in your future or your family's future are on your mind? And how might these tools, now that they're a bit less mysterious, potentially fit into your own financial planning puzzle to provide that real peace of mind? Something to think about.